This is Mark. Mark is a sensible, middle-aged stickman who bought a suburban house 10 years ago for $200,000. Every single month, Mark paid his mortgage on time, slowly chipping away at his debt. Today, his remaining mortgage balance is only $100,000. One morning, Mark receives an email from his real estate agent with some spectacular news. Because of a massive economic housing boom in his city, the market value of his house has spiked to a staggering $500,000. Mark is ecstatic. He does a quick mathematical calculation. He subtracts his $100,000 debt from the $500,000 value. The result is $400,000 in pure, untouched home equity. Mark feels incredibly wealthy. But he has a major problem. This wealth is completely invisible. It is trapped inside the wooden walls and the concrete foundation of his house. Mark cannot use his garage to buy groceries, and he cannot use his roof to pay for a vacation. His bank account is still practically empty, and he is living paycheck to paycheck. The next day, Mark receives a phone call from a very friendly bank representative named David. David says, "Congratulations, Mark. You are sitting on a gold mine of $400,000 in home equity. Why let that money sleep in your walls when you can put it to work? We want to offer you a premium home equity line of credit, or a HELOC. It works exactly like a credit card, but it is backed by your home. We will give you a credit line of $200,000 at a very low, flexible interest rate. You can use this money for anything you want. You can renovate your kitchen, buy a new car, or take your family on a luxury vacation. You only pay interest on the money you actually spend. It is your money, Mark. You earned it. Why not enjoy it?" Mark's logical defenses completely crumble. The bank makes it sound so easy, so modern, and so safe. He signs the HELOC agreement. He receives a sleek, shiny plastic credit card in the mail. Mark feels like he just found a magical ATM that spits out free cash. He immediately starts spending. First, he decides to renovate his kitchen. He tears down the old wooden cabinets and installs expensive, imported Italian marble countertops for $30,000. Then he looks at his old, boring car and decides he deserves a luxury upgrade. He uses his HELOC card to buy a beautiful brand-new SUV for $60,000. Finally, he takes his family on an unforgettable first-class tropical vacation for $10,000. In just 6 months, Mark spends $100,000 of his home equity. He looks at his shiny new kitchen and his luxury car, feeling like a highly successful stickman who has mastered the game of modern finance. Mark is about to discover a brutal financial law of gravity. He didn't find a magical ATM. He didn't unlock his wealth. He just signed a contract that turned his own home into a loaded weapon, and he handed the trigger directly to a ruthless Wall Street bank. Today, we are going to expose the hidden trap of the HELOC market. We will show you how variable interest rates can instantly double your monthly payments, how the bank can freeze your funds without warning, and how borrowing your own equity can turn your most stable asset into a direct ticket to homelessness. For the first year, Mark's financial life was peaceful and pleasant. Under the terms of his HELOC, he entered what the bank called the interest-only draw period. Every month, he was only required to pay a tiny, comfortable interest fee on the $100,000 he had borrowed. The payment was only $300 a month. Mark easily managed this payment from his regular salary, while continuing to enjoy his luxury SUV and his marble kitchen. He believed he had outsmarted the traditional financial system. But then, the global economic climate shifted. To fight rising inflation, the central bank began to aggressively raise its benchmark interest rate. Because a HELOC is not a fixed-rate mortgage, it is tied to a variable index called the prime rate. Within just 8 months, the interest rate on Mark's credit line spiked from a comfortable 3% to a brutal 9%. Suddenly, his monthly interest-only payment more than tripled, jumping from $300 to $900. Mark began to sweat. This extra $600 a month started eating directly into his budget for groceries and utilities. He had to stop saving money entirely just to keep up with the interest payments. Then, the housing market experienced a sharp correction. The economic boom ended, and property values in Mark's suburb began to slide downward. Mark's $500,000 house dropped in value to $350,000. On a cold Tuesday morning, Mark received an urgent email from his bank. The message was cold and robotic. Due to a significant decline in the market value of your property and changes in your local credit risk profile, your home equity line of credit has been immediately frozen and reduced. You can no longer draw any remaining funds from your account. Mark was in complete shock. He had planned to use the remaining $100,000 of his credit line as an emergency safety net. Now, that safety net was completely gone. But the ultimate, devastating blow was still waiting for him. The 10-year draw period on his HELOC officially ended. Mark entered the amortization phase, which banks call the repayment period. During this phase, Mark could no longer pay interest only. Under the contract, he was legally required to pay back both the interest and the full $100,000 principal balance over the remaining 15 years. His monthly payment instantly exploded from $900 to an astronomical $1,800 a month. When combined with his original primary mortgage payment of $1,000, Mark was now required to pay $2,800 every single month just to keep his house. This amount represented more than 70% of his entire take-home salary. Mark tried to call the bank to negotiate a fixed-rate loan, but the customer service department put him on hold for hours and ultimately rejected his application because his house was now worth less than his total accumulated debt. Mark's dream home was now a financial black hole. Mark could not survive this devastating financial squeeze. For 3 months, he tried to work extra weekend shifts and sold his luxury SUV at a massive loss to make the payments. But the numbers did not add up. He fell behind on his HELOC payments. After 90 days of delinquency, the bank did not offer him a compromise. They initiated a formal foreclosure process. Because the HELOC was secured by his primary residence, the bank had the legal right to sell Mark's home to recover their money. Within 6 months, Mark and his family were forced to pack their lives into cardboard boxes, leave their beautiful marble kitchen, and move into a small, rented basement apartment. Mark's hard-earned equity was completely wiped out, and his credit score was utterly destroyed. All because he fell for the illusion of free money. How can a regular stickman protect their property and avoid the fatal HELOC trap? You must adopt 3 defensive financial principles. Principle number 1 is the asset-liability matching rule. Never, under any circumstances, use a variable rate loan secured by your home to purchase depreciating luxury goods like cars, vacations, or expensive furniture. The value of a new car drops by 20% the moment you drive it off the lot, but your debt to the bank remains fixed and growing. If you must borrow against your equity, only use that money for assets that actively increase your wealth or generate cash flow, such as purchasing a high-yielding rental property or investing in a highly profitable business with a fixed rate of return. Principle number 2 is the fixed-rate conversion strategy. If you currently have an active HELOC and interest rates are starting to rise, do not wait for your monthly payments to explode. Contact your lender immediately and request to convert your outstanding variable rate balance into a fixed-rate home equity loan. This will freeze your interest rate, protect your monthly budget from wild market fluctuations, and establish a clear, predictable path to pay off your debt before the amortization period begins. Principle number 3 is the margin of safety test. Before you sign any equity borrowing agreement, Calculate your maximum potential payment based on a worst-case scenario. Assume your interest rate doubles and your primary income drops by 30%. If your total monthly housing costs, including your primary mortgage, property taxes, and the new equity loan, exceed 45% of your net income, you are operating with zero safety margin. Reject the bank's offer immediately. It is always better to be house poor with a paid-off roof over your head than to be a renter of your own home from a ruthless banking corporation. Mark stands in his tiny rented basement, looking at a picture of his old suburban house. He realizes that true financial freedom is not about the size of your credit line or the luxury of your kitchen countertops. True financial freedom is the peace of mind that comes from owning your assets completely, with zero debt and zero leverage threatening your family's safety. Stay smart. Protect the equity you worked so hard to build, and never let a bank turn your home into a corporate casino.